Hello, everyone. Thank you for joining us this afternoon. My name is Joe Minton, and I work for Lightspeed Trading. Today, I'd like to introduce Dan Passarelli from Market Taker Mentoring. Dan is an author, trader, and former member of the Chicago Board Option Exchange and CME Group. Dan has written 2 books on options trading, Trading Option Greeks and The Market Taker's Edge. He's also the founder and CEO of Market Taker Mentoring, Inc., a leading options education firm that provides online options education, options newsletters, and personalized one-on-one coaching for options traders. The company website is markettaker.com. Please keep in mind that this presentation is for informational purposes only. Nothing presented today should be construed as investment advice or a recommendation to buy, sell, or hold any specific securities. Since we don't know everyone's investment objectives or risk tolerance, we are not endorsing any specific strategies. We also encourage you to ask questions as we go through the presentation. You can do that by typing them in the webinar chat box as we go along. Dan will try to answer them as we go, or we will get to them at the end of the presentation. This presentation will be recorded and uploaded to our online webinar library. You'll be able to see this, as well as most of our past webinars, online at lightspeed.com/webinar. So if at any point during the presentation you miss something, or you want to go back and reference it at a future date, you can always go to our website where it will be archived. If you have any specific questions about what you are seeing, please feel free to contact me directly at joeminton@lightspeed.com, or by visiting our website at lightspeed.com, where you can request a demo of the platform at any time. At this point, I'm going to hand over the presentation to Dan.
Hello, everyone. Welcome, and thanks for attending my class today. Can everybody see my screen? All right. I'm going to assume that's a yes, otherwise somebody would be telling me no. So welcome. Here's what we're going to do. I'm going to go give my presentation here today, and you'll probably have some questions. I'm going to save all the questions until the end, okay? So if I don't answer your question, I'm not ignoring you. I'm just waiting until we get towards the end of the presentation, and I'm going to leave plenty of time for Q&A. All right. Today we're going to be talking about credit spreads. Before we get started, I need to point out that options are not for everyone, and you should read characteristics and risks of standardized options before trading, and you can get a copy of that by calling 1-888-OPTIONS. That's the home of the Options Clearing Corporation here in Chicago. All right. So we have credit spreads for a specific reason. And the reason why credit spreads exist and are so popular, they're arguably the most popular active trader option strategies out there, is because it enables us to do one thing: to sell options in an optimal way. Now, for those of you who have never sold an option, maybe you focus strictly on buying options, you've probably run into some trouble here or there every once in a while. And it can be very, very difficult to be an option buyer, to be somebody who simply does nothing but buys options. What's the trouble you run into? Well, the trouble you run into is time decay. Time decay is this observable phenomenon that as time passes, options slowly lose a little bit of their value. Now, I don't mean they definitely every single time just lose a bunch of value. What I mean is options can make money when the stock goes up or down, or lose money when the stock goes up or down. They can also make or lose money based on volatility and interest rates and that kind of thing. But one thing that works against them, independent of all those other option factors, is time passing. We refer to this as time decay or erosion, and it's measured by the option Greek theta. So those of you who are option buyers who said, geez, I can't figure out why it's so hard to make money buying options, well, that's probably why. So then at some point you figure out, well, wait a minute, if it's hard to make money buying options, what if I sell them? Put time decay on my side and in my favor. Well, there can be an advantage to that. Theta always benefits you when you're an option seller. But there's a couple of things that can work against you. First of all, your direction can be wrong. If I sell a put and we get a week like we had last month, for those of you who are watching this live, not recorded, last month we had a day where the market was down a whole bunch in a single day. The days surrounding that, it was down a lot too. If I'm wrong on direction, I can lose a lot. I can lose way more than I stand to make when I sell options. And in fact, if there's a market crash or something like that, I could be trying to make a couple $100 and I could lose, thousands of dollars, $10,000, something like that. So that doesn't sit well with a lot of people. We like to keep our profits big and our losses small, and if I'm just selling naked options, I can end up in a situation where it's quite the opposite. So I need to have a solution to that problem. And when it comes to credit spreads, I do have a solution to that problem. I can use credit spreads instead of selling naked options. I can sell call credit spreads. I can sell put credit spreads. Those are the two types of credit spreads that exist. A call credit spread is when I sell a call. It's typically out of the money when I sell it. And I buy a higher strike call that's further out of the money with the same expiration cycle on the same underlying. So you probably, if you've done some reading on options or you have some experience with options, you know that selling naked calls is a somewhat frowned upon endeavor because you can have unlimited profit potential. If you sell a naked call on a company that gets taken over, there's a real situation where you can stand to make $100 and you end up losing $5,000. Well, credit spreads can solve that problem. Put credit spreads, same thing. I sell a put, typically an out-of-the-money put, and as protection, I buy lower strike puts in the same expiration cycle on the same underlying. So in both of these, I'm selling an out-of-the-money option, and then I'm buying a further out-of-the-money option. Looking at my screen here, and it kind of looks like there might be something crazy going on here. There we go. Just had a window that seriously popped up. Sorry about that. So in both of these spreads, we're selling an out-of-the-money option, we're buying a further out-of-the-money option. So here's the deal with credit spreads. Here's how I want you to think about these. There's two different options, and each of the options has its own special role in this strategy. The option I'm selling is the trade. That's my risk, and that's my reward. The option I'm buying is my insurance policy, my protection. That's what prevents me from having humongously disproportionate losses time to time. Now, I'll tell you what. I work with option traders every single day. Joe's kind enough to give me a nice introduction there. I think he mentioned that my company is Market Taker Mentoring, where we teach people how to trade options. This is what I do every single day. I talk to option traders. I know that there's probably a couple of you in this room who have a little bit of what I'll call pushback right now. There's a couple of, just statistically, I know there is. Statistically, I know that there's a couple of you guys saying, well, wait a minute. Why would I sell a put spread instead of just sell a naked or a cash secured put? Don't I make so much less if I sell a put spread instead of just selling the naked option? Because, just imagine, we're going to look at an option chain here in a second, but just imagine this for a minute. Maybe there's a stock at $75, and you can sell the 70 puts for $2. But you can sell this 65 put spread, sell those same 70 puts for $2 and then buy the 65 puts to complete the spread for $1. So, I'm only collecting half that. I'm collecting $2, but I'm paying $1, so I'm only making half the profits if I do that. Right? Some of you guys are thinking that, aren't you? Well, I've got a solution to that problem. You guys who are experienced with credit spreads, what's that solution? I can sell 2 spreads instead of 1 put. I I can make it so that I make the same amount of profit. But when I sell two spreads instead of one naked put, on those days when the market crashes, or the days when there's a correction overnight, the days when the market loses 5% and there's nothing I can do about it because it happens too fast, I'm not going to lose thousands and thousands of dollars. I'm going to have a much smaller loss because I have protection, because I have a spread. So if you're an active trader, it almost always makes more sense to do a credit spread rather than a naked option. Now, let's talk about that a little bit more too. I'm saying if you're an active trader. I also speak to people who are conservative investors who use options. Now, if you're a conservative investor who uses options to enhance their returns, it might be okay to use a cash secured put if you're hoping to get assigned and take possession of the underlying stock. That could be okay, but that's something different. For active investors, it almost always makes more sense to use credit spreads. It's lower risk and the same return. Okay, so when you put on a credit spread, you've got two risks: delta and beta, direction and volatility. Now, when I say risks, I mean both the risk of losing money and also the potential for making money. So, as a trader who, I've been in the options business for over 20 years. I know if you're in the options business long enough, you're going to have plenty of winning trades and plenty of losing trades. Not every trade is going to be a winner. So I need to put every single thing I can in my favor whenever I make a trade. I want to give myself every possible opportunity to make money. So when I'm setting up a credit spread, I want to put both direction and volatility on my side. So before I show you the exact methodology for setting up these trades, I'm going to give you a couple of guidelines here. First and foremost, as with any option strategy, you need to always, every single time, know what your maximum loss potential is and your maximum profit potential. You also want to set up a credit spread as a high probability trade. Now, what is that? Well, I'm sure you've read some of these newsletters by these guys who say, oh, I win on 99% of my trades and all that because I'm so great at picking direction. Okay. Obviously, those aren't always true. But with credit spreads, you actually can set up a measurably high probability trade. With credit spreads, you actually should statistically have more winners than losers, and a lot more winners than losers. And I'm not saying because, hey, I'm going to show you, how to be psychic, how to pick where the stock is going better than somebody else. No. This is not about prediction. This is not about, having some, secret plan to be able to tell you where the stock is going to be tomorrow. That's not it. This is about using math. This is about using statistics to set up a trade that will win more often than it will lose. There's a better chance of winning rather than losing. So we'll get into that in a minute. We also want to construct these trades to have about 2 weeks, maybe 1 week, but usually 2 weeks to 6 weeks until expiration. Now, those of you who are somewhat experienced as option traders, you probably know what I'm talking about here. Why don't we want to go out and put on a trade that has more than 6 weeks until expiration? Well, it's because of how time decay works. Options lose their value as time passes. That's the whole premise of this trade. We want to make money from that. So we want to see these options lose their value at as fast a rate as possible. The less time until expiration an option has, the faster of a rate it loses its value. So if I sell a credit spread that has 6 months until expiration, well, the thing that benefits me, time decay, helps me just a tiny bit. But if I sell a credit spread that has 2 weeks until expiration, the thing that benefits me helps me a whole bunch more. It loses its value at a much faster rate. Now, you might say, well, wait a minute. A 2-week option is going to have less value than a 6-month option. So I'm not going to make as much. But how many 2-week periods are there in 6 weeks? It's like 12 or 13 or something like that, right? So what I'm getting across here is if I sell a 2-week option 12 weeks in a row, you know, I sell a 2-week option, it expires, and I sell another 2-week option, and I sell another 2-week option, 2-week period after 2-week period, I should make way more than selling one 6-week option, or 6-month option. Interesting. See, we're talking about looking at these little nuances of option pricing that you can put on your side. Also, with these credit spreads, we want to make sure that earnings is not due out before expiration. So right now, at the time we're recording this webinar, it's earnings season. Any stocks that already have their earnings out, great. They might be candidates for a credit spread. Some stocks that have earnings that are due out in 2 more days, they're not candidates for credit spreads. Why? Well, because with credit spreads, we want the underlying stock to not move very much, as we'll see in a minute. So, all right, I promised to show you the methodology for setting these up. Here's the setup. We're going to start with direction. We're going to find a stock that has hit support or resistance and bounced off. And we're going to use that support or resistance level to set the potential short option strike. That's step 1. Step 2, we move on to volatility. It's going to be a filter. We're only going to put on a credit spread trade if volatility is elevated. All right. So that may or may not resonate right now or make perfect sense. I'm going to show you how it works. Look, here is a chart. What is this? This is Baidu, I guess. I took the screenshot last week or the week before, something like that. It's a reasonably fresh screenshot. And what do we have in Baidu? We have resistance at $150 a share. We've got Baidu hit $150 about 3, 4, 5 times over the past 2 months. And the 50-day moving average is acting as resistance as well. So what does resistance mean? Well, it's a point that the stock has proven that it's just had a hard time rising above in recent past. Then we're going to move on to volatility to see if this is a reasonable trade for a credit spread. In this case, it is. There's no real secret weapons in trading, but if there was a secret weapon, this would be the secret weapon. This is what separates good credit spreads from bad credit spreads. This is called a volatility chart. Those of you who are familiar with the platform here, LiveVol for Lightspeed, they have great volatility charts. I use them all the time when analyzing trades. The red line is implied volatility. The blue line is historical volatility, bluish-gray. So the bluish-gray line, let's start with that one. That's the easy one. That is historical volatility, and what that means is it's a measure of how much the underlying stock has been moving around lately. Now, for the past 6 weeks or so, the blue line has been pretty flat. It hasn't made any big major moves in the past 5, 6 weeks. So that means the actual volatility of the stock has been reasonably stable over the past 5, 6 weeks. which we like to see when it comes to credit spreads. The red line is the implied volatility. Now that is basically how cheap or expensive the options are. I mean, specifically what it is it's the volatility figure that when entered into an option pricing model makes the theoretical value equal current option prices. Yeah, that's a little esoteric, it's a mouthful. Just think of implied volatility as this is how cheap or expensive options are. You think about it that way, you're going to be 10 steps ahead of most of the new option traders out there. So what do we see there? Well, we see the red line it's actually at about the top half of the 6-month range, isn't it? And it's above historical. So what does that mean? Well, that means something really important. That means options are expensive. And when something's expensive, do I want to buy it or sell it? You want to buy it. Or excuse me, you want to sell it. When things are expensive, you want to sell them. So we're in a nice situation here for a put credit spread. We've got an established resistance. We've got overpriced options. Let's sell some options and buy insurance to limit our losses. So here's what we're going to do. We're going to sell calls that are at or above resistance. Now recall that resistance was around $150 a share. So I'm fine selling the 150 calls. And then I'm buying my protection to complete my spread. I'm buying the 155 calls. Now why am I selecting these particular strike prices? Because of where resistance is. Because the stock has had a hard time rising above $150 a share. So what if I put on this trade, sell those 150 calls and buy the 155s for protection? And what if the resistance line holds and Baidu stays below 150 between now and expiration? Well, if that's the case, I'll make money. In fact, the entire 81 cents that I collected when I first put this trade on is mine to keep, and the risk disappears. The options expire. Right? If I sell the 150 calls and buy the 155 calls, if at expiration the stock's below 150, those calls expire, and the 81 cents I collected when I made the trade, that credit, hence the name credit spreads, is mine to keep. So let's back up a second here. The stock was at 141.80 when I could put this trade on. So just think about this. Think about stock prices like a professor, like a statistics professor would. A statistics professor will tell you no one can predict stock prices. Now, I know no one can accurately predict stock prices, but I think some people are a little better than others at forecasting. But there's never been anyone who's walked the earth who can always predict stock price. So, there's something to saying stock prices aren't really predictable. So let's just pretend that we're sort of a naive college statistics professor, and we say it's impossible to predict stock prices at all. So here's the thing. That would tell us, a statistics professor would tell us that there's about a 50-50 chance of the stock being above or below 141.80. 50-50 chance of rising or falling. Technically, stock prices are thought to be normally distributed, so there's somewhat of a better chance of them rising than falling, conducive with the interest rate. But if I was talking to a college statistics professor and I said, well, so what is there, about a 50-50 chance? He'd say, you're about right, but, and then he'd probably go into some really complicated math to tell me why it's not exactly right. But it's about 50-50. So, let's imagine if 50% of the time the stock ends up going lower, well, I make money if the stock goes lower, right? And if the stock stays where it is at 140, 180, I make money. And if the stock rises a little bit all the way up to 149.99, not quite to 150, I make money. So statistically speaking, I can quantify mathematically, I have a better chance of making money than losing money. It's not because I'm so great at predicting markets. In fact, it's because I'm acknowledging that I can't predict the market. But it's because I give myself a head start. The market has to move significantly in the wrong direction for me to be in trouble. It can move wildly in the right direction, a little bit in the right direction. It cannot move at all. It can move in the wrong direction a little bit. All those permutations of the future price action, all those things can happen, and I have a winning trade. Okay, so so what if the stock rises and it's above 150? Well, that's where we could run into some trouble. Let's imagine that I hold this all the way until expiration. The stock's above 150. What happens to my 150 strike calls if the stock's above 150 at expiration? I get assigned on them, and I end up with a short stock position. So the higher the stock goes, the worse in that case. But I need to recall that I collected 81 cents a share when I put this trade on. So as long as Baidu doesn't rise above the strike price plus my premium collected, or 150.81, my trade's a winner. If it rises above 150.81, my trade's a loser. But I have limited loss because of my insurance policy, because I bought the 155 calls. The most I can lose here is $4.19 a share. Now that's still more than I stand to make, but it's a whole lot better than selling a naked call, first of all. And second of all, this is a high probability trade. The odds are in my favor, so I'm willing to give up a little, proportionality here as far as my risk reward goes. Now I mentioned volatility as the kind of secret weapon, if you will. Here's why it's important to use volatility to only sell expensive options. I sold this spread at 81 cents. If the volatility was lower, I would have sold it for less. Maybe I would have only sold it for 65 cents, maybe. Well, if I sold this spread for 65 cents, then best case scenario, I wouldn't have made 81 cents. I could have only made 65 cents. With credit spreads, I can only make the credit I receive when I make the trade. If I collect less up front, my maximum profit is lower. So here, because I collected more, because volatility was higher, I collected a bigger credit, my maximum profit was bigger. And my maximum loss potential was smaller, because my maximum loss potential is a function of my credit received. I calculate my maximum loss potential by taking the difference between the two strike prices. That's 155 minus 150 minus my credit received. So if my credit received is bigger, my loss potential is smaller. So when I'm using volatility to only sell expensive spreads, I make my trade better in every single way. I make my trade better because if it's a winner, my maximum profit is bigger. If it's a loser, my maximum loss is smaller. And my potential for winning is bigger too, because my break even is a little further away from the money. So this stock, or this trade rather, has a number of strengths. First of all, the spread has strong resistance at 150. That helps me have something that can help keep the stock below where I run into trouble. It keeps the stock below the strike price because I set my strike price with resistance. This simple moving average also provided some extra resistance at that level here. The stock had to rise over 5.5% for this to be a losing trade. So again, it could fall, it could stay where it is, it could rise about 5.5%, and I still have a win. And the market overall, when I took the screenshot, and even currently, I'd go as far as saying it's not extremely strong these days. So the overall market kind of helps me some too. From a volatility standpoint, option prices as measured by implied volatility are expensive, so that makes my spread a whole bunch more attractive. So, I mean, in a little over a half hour, I basically explained everything there is to know about trading credit spreads. I mean, don't get me wrong, I've been doing this a long time. I'm sure there's a couple more details that I can work into this here. But this is how credit spreads work. It's really a two-step thing. Look at direction, look for support or resistance, and then look for elevated volatility. I'll throw in maybe one more third step, have a little bit of a sanity check, like, you know, if there's resistance and the volatility chart looks good, but you can only sell the spread for 2 cents, you don't want to do it. And then the other thing is, of course, how you manage it, and that's a whole other ball of wax, but, you know, you need to have a plan. You need to say, hey, if the spread goes my way, am I going to hold it all the way until expiration? Am I going to take it off before expiration? My plan is, and what we teach our students is, if you can take 75% of your maximum profit, take it. Because at some point, the risk reward isn't really quite there anymore, and you might as well. Then you can move on to the next trade and take an even bigger credit, and it kind of adds up and all. If the thing goes against me, how am I going to handle that? Do I just let it ride and hope it comes back? Do I close it and take a loss? Do I do an adjustment? So having a plan is what's going to really help you make this succeed. Now, I'm going to take some questions. I want to briefly mention a class that we have here at Market Taker where you can get trade ideas. How would you like all the trade ideas you could possibly ever need? Given to you every day by someone who's been in options over 25 years. Do you think your trading would improve if somebody who's been in the options business over 25 years is giving you trades every day? Well, I want everybody to go to this website right now, markettaker.com/GC_special. GC_special. Everybody go to that website right now. And again, I'm going to take Q&A in a second. I just want to tell you about this really quick. This is our Market Taker Live Advantage Group Coaching. You get 3 months of trade ideas. This is an every single day class. It's webinar fashion, just like this. You log in every day at 9 a.m. Central Time. And our head coach, John, opens up his live platform and shows you trade setups every day. You get about 10 trade ideas every day. If you can't make a class, or if you can never make that time of day, that's fine. All the classes are recorded. You still get the same value. In addition to that, we're going to throw in our email hotline. You ever have a trade that runs into trouble, it goes against you, and you're down money, and you say, man, I wish there was an adjustment strategy for this. I wish there was somebody, a professional that I could ask. That's what the options hotline is. We sell that for $1,000 on our website, but you're going to get it free today. And you're going to have one-on-one coaching session with me, personally. I'm going to call you up on the phone. We're going to talk for an hour about trades that maybe you're having trouble with, or your trade methodology, or different strategies you can use, how to become a better trader. This is a $500 value, but it's yours free today. So you have two choices. There's a 6-month class, which for 3 months access to this everyday class, we typically sell for $997. That's a good value in and of itself, because if you make money on, 2 of the 1,000 trade ideas you're going to get in 3 months, it can cover the cost of the class. But today, you're not going to pay full price. You're going to pay half that, just $497, and you're going to get the email hotline and the one-on-one phone coaching with me. If you want to save a little bit of money, you can do our 6-month access. Normally, that's a $1,700 class. but today you're getting it for $7.47. Just visit markettaker.com/GC special, markettaker.com/GC special, and anyone who signs up as a result of this today during this webinar, I'm going to put one of my books in the mail to you today, an autographed copy of The Market Taker's Hedge. That's a book I wrote a couple years ago. It's published by McGraw-Hill, where I tell some stories from back when I was a trader down the floor of the Chicago Foreign Options Exchange, and there's some pretty good education in there that I think you'll benefit from. Now, does anybody have any questions about today's class or about this class that I'm talking about here, or anything? Send in your questions, and I think maybe Joe, can you read them to me if you send them in? All right. Either there aren't any questions, or maybe Joe's just kind of letting me take this one now myself here. Looks like there's questions. Joe, you around, or?
Dan, can you hear me?
Oh, there you are. Hey, how are you?
I'm just sending to you on the chat
Okay,
program.
perfect.
Can you see them down below?
Yeah. Now I see
Okay.
one chat. It says
There's gonna be a few more. I'm just typing them in slowly here.
Okay, cool. Yeah, so the website again is markettaker.com/GC_special. That's GC_special. And that'll take you to the webpage where you get your choice of the 3-month half-price class or the 6-month even less than half-price class. Oh, there we go. The next question. Okay, so we have a question here. It says, well, why not use delta on the short strike to horseback the likelihood of the underlying getting to the short strike? Great question. It's kind of funny. I've heard people say you should use delta, but if you think about it, it's kind of silly. It's so much less powerful than using support or resistance. Because if the delta is 30, so, okay, by the way, some of you guys who are new, let me tell you what me and this caller are talking about here. Delta can be used as an estimate for the likelihood of an option expiring in the money. So if my 50 straight calls in my example had a 30 delta, that means there's a 30% chance of the option expiring in the money. That means there's a 70% chance of it not expiring in the money and me having a winning trade. But who cares if it's 30 or 25 or 40 or 16? What does it matter? That tells you, here's what my chances are, but if it's a smaller delta, it's a smaller credit, and so I have less to win and more to lose. You know, your risk reward is directly proportionate to your delta. I mean, what if you did this? What if you used a 2 delta trade that's ultra far out of the money? Well, then you're probably selling that credit spread for a penny, and you can lose $4.99. Is that a good trade because it's a small delta? No. Delta is actually very arbitrary, but support and resistance is not. Resistance means, hey, here's where in the past the sellers came in and pushed the market back down. There's the potential for other traders to basically help you out if you're using support and resistance. Because if you know, hey, that's where the big sell orders were in the past, because that's the only reason the market falls, is there's more sellers than buyers. If that's where the big sell orders were in the past, then, you know, I'm banking on them maybe being here again. You know, that's actually some extra thing that's not just, oh, well, now I know what my chances of success are, but, you know, so what? My risk reward is proportional. There's something extra that goes above and beyond that gives you an extra edge. So that's why it's better to use support and resistance rather than delta. Okay, here. Next question. Does your site give suggested risk management plans? Yes. That's one of the best things about this class. You know, you can sign up for a newsletter and have somebody say, hey, here's a great trade, go trade it, just trust me. You know, and you gotta have a lot of trust in somebody you don't know to sign up for a newsletter like that. But here, we're not just saying, hey, this is a great trade, go trade it. We're saying, hey, look, here's the trade setup, and you know, here's the support level right here, and here's how the implied volatility lines up, and so you could put on these strikes here, but it's better if you put it on this way because you have a better risk reward. Like, it's designed to be earn while you learn, and we also, John will also say, hey, look, if the stock gets to this level, then the thesis is no longer valid. Here's where I would cut my losses so I can keep my losses small. Here's where I would take it off for a profit. And then sometimes 3 days later, it'll say, hey, remember that trade we talked about 3 days ago? Well, this is an area where I would love to take my profits. So, yeah, we definitely have the risk management plans that go along with it because that's key. Here's a really good question. Somebody says, why would you take a 4-to-1 risk reward in your example? That's a good question. When you're new to credit spreads, that doesn't always make sense. Like, why would I risk more than I can lose? It's because it's directly proportionate also to your risk reward. You know, like, if you go to buy a lottery ticket, you know, your chances of winning the lottery are like 180 million to 1 or something, okay? You're not likely to win. So how would you feel if you buy a lottery ticket for $1 and if you win, this miraculous thing happens, 180 million to 1, you actually win the lottery? What if they pay you $1? They pay you 1 to 1. Do you think that makes sense, that risk reward is congruent with the probability of winning? No. So that same concept kind of applies in my example. Well, my chances of winning are way better than 50-50. You know, my chances of winning are extremely high. The market has to rally 5.5% for me to lose. So I can't expect to, you know, a 10-to-1 profit. You know, obviously my risk reward is going to be disparate, you know, against me, where I'm risking basically 4 to make 1. It's okay because my probability of success is so much better. So with options, there's always a trade-off between probability of success and your risk-reward structure. So yeah, really good question. Hi, Kat, how are you? This question is, well, after you look at support and resistance, okay. Yeah. Okay, right. So, Kat, I think you're just, Kat is one of our students here at Market Taker, incidentally, and I think she's helping me explain the idea of using support and resistance. So, great questions, and I'm not at my regular computer here right now, so I don't know how many people enrolled in this special offer, but I did say before I hang up this call, anyone who enrolls during this webinar, I'm going to send you a hardcover autographed copy of my book, The Market Taker's Edge. So, tick, 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 looks like we're running out of questions. Now is the time to do that. But I would love to answer any more questions that you might have. So if you do have some more questions, Joe says we have one more. One more question. It's coming. It's probably a long one. Here we go. What happens when your trade goes against you? Wait it out or roll? Says Ron. Ron, that's part of your plan. You know, that's what I was talking about during this presentation. You know, my last bullet point was make sure you have a plan. Yeah, that was what somebody was asking about this class. Hey, you know, do you talk about the plan? Yes, because the plan is part of the trade. The analogy that I've used several times lately is, you know, trade is like, you know, driving a car. Like, before you even get in the car, like plan where you're going. You don't just get into the car and start driving somewhere and think, oh, well, where am I going with this? You know, it's the same thing with having a trading plan. You don't just put on a trade and say, okay, hope it works out. I don't know where I'm going to take it off, but, you know, hopefully I make money. Or hopefully I don't lose too much. So what you do is, here's a very simple rule especially for beginner traders. If the stock goes through that resistance line, because the resistance line is a big predicate of this whole trade. If the stock goes through the resistance line, my thesis on the trade is really no longer valid. So when the stock goes through your support or resistance line, that's where you take the trade off. If enough time passes, you might not actually even lose anything on it. If you put the trade on today and by the end of the day it zips through your support or resistance line, well, you know, you're going to take a loss, but it's better to take a small loss now than a big loss later. All right. Well, that is all we have today. Thank you for attending this class. Again, it's half price for 3 months and less than half price for 6 months. If you want to save some money, go to markettaker.com/GC special. And if you have any questions, you can email me, dan@markettaker.com. And follow me on Twitter, twitter.com/Dan_Passarelli. That's twitter.com/Dan_Passarelli. Thanks for attending my session. Have a great day.